He's one of the few people in the entire financial world to correctly call Donald Trump winning the election even before the primaries were over. There's the really neat trick. But what does the future hold for U.S. markets and the economy now that Donald Trump is in the White House? In his first broadcast interview in the new year, one of the most followed voices on Wall Street and Main Street joins us in a Fox Business exclusive. Billionaire bond king and Doubleline Capital founder and CEO Jeffrey Gundlach, who, by the way, has amassed more than $100 billion in assets over just 7 years. Thank you so much for joining us. Okay, you made the Donald Trump prediction perfectly.
Yeah,
well before anybody.
It was before the primaries began, actually.
Before it even began.
Yeah.
What did you see that gave you that window into what eventually would happen?
He had his pulse on the kind of forgotten people in, well, it turned out to be rural America, but the middle class. And it would seem quite clear that Hillary Clinton would be the nominee for the Democratic Party. And I just thought she was a really weak candidate based on the performance in 2008, really.
Were you a supporter of Donald Trump? I
voted for him. I'm not really very political, but I do vote. So I did vote for him. Not terribly enthusiastically, but I thought it was the best candidate that was on the ballot.
Well, I'll tell you what's been enthusiastic is the market reaction since Election Day.
Sort of shocking, really. Wall Street and investors have really changed their attitude almost instantaneously. I mean, days before the election, there were notes from major research firms talking about global depression. I think there was a major investor who said the S&P would drop 80% if Donald Trump won. He wasn't predicting he would win, but he said if he does, it'll drop 80%. And then all of a sudden, the same week, later in the week of the election, there were crawlers on financial media with the notes being written saying Trump is great for stocks.
Yeah.
And it's a little bit strange how people change their attitudes so quickly. I don't think I've seen such a 180-degree turn in sentiment ever in politics or in financial markets. I wonder if it will last because, you know, it's not linear.
Well, let me get to that. Dow 20,000 is suddenly within somewhat striking distance.
Yeah, we're there. I mean, just rounding. Yeah, we're there, and we'll go to new highs on the stock market, I think.
How high?
I don't really know. I think we'll go up moderately from here. I think the problem will come in the middle of the year when interest rates, which are now dropping a little bit because the bond market is ridiculously oversold and positioned against. But ultimately, I think interest rates are going to move higher towards 3% on the 10-year.
It's starting to look, though, very toppy for equities. I'm just wondering, is this a sucker's rally? What do you see in, look, we're just a few days into 2017. Yeah. Are you seeing any dislocations or gyrations in market metrics? No, I think the thing that strikes me is how the U.S. market seems very expensive relative to global markets. I think, you know, when foreign markets do well, when emerging markets are on a tear, when Europe did well like it did in the first quarter a couple of years ago when they started with some of their quantitative easing programs and the like, all of a sudden investors start falling in love with foreign stocks because they're up massively. And they start to convince themselves that diversification is a good idea, which is really just a Trojan horse for buying stuff that's really up a lot and maybe overvalued. We're in the opposite situation now. The U.S. market has done really well. And a lot of other markets haven't done nearly as well, and they look kind of cheap. So I think investors should think about diversifying, using this weakness, relative weakness in foreign markets to diversify away from the U.S. I'm not bearish on the U.S. market. In fact, I think it's going to new highs. But I think it's a good time to diversify. Well, okay, so if we start to look a little too rich at this point, we know that we're heading into the inauguration. Markets traditionally sell off a little bit after inauguration. Well, right. There's a pattern that's pretty predictable, and that is after an election, you see some enthusiasm, some good sentiment. And then somewhere around now, in the period before the inauguration, or moderately later, maybe a week or two later, you do tend to see a top. So what's the investment warning you feel compelled to give people right now who are listening? I don't really have much of a warning other than really on the stock market. I have advice that the rally that's now happening in the bond market is a good opportunity for people to think about changing their bond investments. Well, how? Well, you know, interest rates bottomed in July at 1.32 on the 10-year. And at that time, there was really a monumental belief
in Treasury bonds. In fact, I got together with my team and I said, I don't think I've ever seen anything quite this bad in terms of a bond market setup ever. In terms of people saying, there were headlines that said yields can never rise. Well, in this business, when you hear the word never, it means it's about to happen.
Well, 2.62% was the recent high on the 10-year.
264 intraday, that's right. And so it doubled, exactly doubled. Well, I think almost certainly we'll take a peak at 3%. During 2017. The danger is that if we go above 3% on the 10-year, which is certainly possible, I think you have to, from a chart perspective, just say unequivocally that the bond bull market is over.
That's the thing. People are looking at this point for, at least some are, a cushion of safety, but others are really on the stock bandwagon. They're saying stocks versus bond because Donald Trump is going to cut corporate tax rates. He's going to cut all tax rates. It's a blue sky scenario. Where do you start to see the clouds?
All those things are possible, and if they happen, they're good. The question is, will they happen? And that's what I mean by it's not necessarily a linear type of a thing. Certainly, corporate taxes being cut is positive for stocks. But what about tariffs on certain industries? It's all very complicated. There's supply chains that it's not clear that just because something is manufactured overseas that it's just that country's work.